everybody, and welcome to Hard Assets Investor. I'm Mike Norman, your host. Today, my guest is David Gurwitz, who's the Managing Director of Charles Nenner Research. Happy to have you here.
Nice to meet you, and thank you for having me.
Thanks. You guys made a terrific call in gold a couple of years ago when your research and the algorithms that you use called the top at 1900. So I'm very curious to hear what you have to say about gold now, as well as some of these other markets.
Great. First, let me tell you how it works, and then gold happens to be a specific category that fits in with everything else. Cycles come from the Greek word circle, and what we do is we take any data series and find basically repeating top to top. So I'll give you an example. When baseball, you hit for the cycle. You have to have a single, double, triple, and homer. People think of the 9-year cycle. We look at things, if you find a top in gold every 5 weeks, forget the price, top every 9 weeks, top every 14, top every 37. You have, in effect, a lot of sine curves. When they're all topping, why we don't know. We were talking before. I don't know why things happen. We don't know why things happen. When they're all topping, we just assume that's a top, and they were all topping at 1900.
But here's the thing, and you probably heard there was a book written, Fooled by Randomness.
Yes.
Okay, it's sometimes we can look at things as human beings, and they kind of look, like there are discernible patterns there, when in fact what it really is randomness, but we perceive it as some sort of regularity. Okay, can you be fooled by this phenomenon? Maybe it's just random and it looks like a cycle, because look, let's face it, if we knew precisely that cycles occur at this moment, at this moment, at this moment, then somebody who knew that would own the world in a month. I mean, it'd be so easy to make money.
Right. I want you to know there's another book, not Fooled by Randomness, called Chaos, which basically says there's not randomness, that in fact it is predictable, there's patterns within chaos. It's the other side.
Well, it's like Einstein saying, well, God doesn't play dice with the universe. Right. There has
Einstein
to be some order.
But
he never proved that.
Let me tell you what Einstein said about relativity. When a man sits at a radiator for a minute, it feels like an hour. When a man sits with a woman for an hour, it feels like a minute. That's relativity.
Well, we're getting too deep for this show.
Yeah, let's got to get the gold people here. So anyway, we don't believe it's random. We don't agree with that premise. Okay. So therefore, we believe that you can find patterns, and go to our site, Charles Nenner Research, all the many listeners here and readers, and watch and get a free look for a month or so of the research to see how we do it in stocks, bonds, commodities, currencies, grains, and economic indicators. We call the top an apple. Nat gas, we were talking before. What came first, the cycle top or what I'm about to tell you? The banks in Canada lent money to the nat gas producers when nat gas was $6 not long ago. We had said nat gas was going to $1.70. Got to $5, $4.50, $4. All of a sudden, those loans, like a lot of people's houses, the mortgages are underwater. Bank loans are underwater too, to companies. They started pressuring the nat gas companies to sell, to pay back the loans. They started selling. Price goes to 3 to 10. It got to 190. What came first, the cycle top or the actions of the banks? We think the news shows will all say banks forcing producers to sell. We think it was the cycle top that said it. There's a cycle bottom coming in gold very shortly. We've had 7 up years of gold. You know better than me.
So it doesn't necessarily tell you the price or the proximity of the price. It just tells you, here's a time window where we're going to hit a bottom.
We also do price.
Oh, you do?
Yeah, because football, you'll go back. We're both former athletes, maybe current. The quarterback goes 1, 2, 3, 4, and he throws. Same with us. Cycles just give you direction. Target algorithm, which is based on rocket science, believe it or not, and quantum physics, it does get very deep, gives you level. Okay, and so we look for timing, level, and direction, and when they don't all line up, we will stay out, which is something most people have a hard time doing. So they're in pain staying in the gold trade now, as you probably know. A lot of people are sitting now crying and they're going to probably sell.
Not if they're short.
Not if they're short, which is also emotionally not so easy to do. Yeah. When it gets to the bottom, which we think is coming relatively soon, they're going to sell out, and we think there's going to be a great opportunity.
And what price would that be?
13s, high 13s is what we're looking at.
So that the recent sell-off that brought us into I guess it was the mid to low 13s, that was like a capitulation?
Almost.
Like we'll retest?
We'll retest probably because we want everything to line up, the cycle, the target, and the other things we look at. MACD, there's a triple top forming in the euro right now. Again, I won't go through the details. This is the stuff we do. We're a little technical, but we think the technicals are in fact fundamental.
All right, so this cycle, what duration? Like if let's step back a little bit, look at the big picture, okay? We've had this rally in gold now for basically, 10, 11 years, since 2001. Now we're having, I guess you're saying it's coming near the end of this correction. It would suggest from what you're saying, we're in the next, leg of this long-term bull market.
Yeah.
And I guess I could project or extrapolate from that. That would be your macro view of commodities in general?
No. That's a good question. Everything's different. Gold is going to go up based on our cycles, based on our forecast. Silver, same. Copper is down. We got out of copper 6-8 months ago. We have a lot of sovereign wealth fund clients. They don't want to trade next week, next month. They want to know 4 years from now. They have 80 billion. So copper's down, which indicates something about not such a great economy. Nat gas, which went from $6 to close to $1.70, is now in the low 4 range, and very shortly we think we're going to short it again back to its low again.
So it's not done.
No. Well, everything's different, right? So grains, we think, are bottoming in several months, and there's going to be a rally in grains. So we don't look at, people say stocks and bonds always go opposite direction. If you bought stocks and bonds in 1981, it was both a great trade. 30 years, they both went up. If you bought them both in 2000, bonds have done well, but stocks are flat from 2000. If you bought them from 2007, bonds have done well, but stocks haven't. So you can't just say A implies B.
So you have to be selective in the commodity sector.
Correct.
You have to be selective. All right, let's talk about equities, because equities, the Dow making a new historic high, S&P at a new historic high. And a lot of people are looking at that and saying, hey, it just doesn't add up because the economy is not that strong. Still have high unemployment. So what is it telling you for equities?
Long term, we see stocks going down for the next 7 years over 60% down.
60% down?
Yes.
For the next 7 years?
I want to say that again. 60%, right? The Dow goes to 5,000.
Based on what?
Cycles.
Really?
That's all we know. We admit. We were talking before.
How did it work with the 2007, 2008
Right. I'm going to tell you a story. We took everyone out in the summer of 2008. If you go to our site, Charles Nenner Research...
That was right before the Lehman crisis.
Right before. We don't know what's going to be. The reason shows up afterwards, after the cycle.
So you really didn't get the top in that one.
We got out.
At the top in late 2000.
Prior, when the Dow went from 10.8 to 14.5, we called that on CNBC. It's on the site.
Okay.
And then we got out in the summer. We went back in and got out in the summer of 2008. It was not a fun end of 2008, as you can remember.
Right.
We went long beginning of 2009, more or less until now.
Again, based on the cycle.
Only based on the cycle. We don't know anything else. We admit we don't know.
Is that your motto?
How often do people come on and say we don't know? Right? We admit we don't know.
It's honest.
We're brutally honest. That's one thing. And then, so stocks are topping. Wow. Stocks are topping, and they're not going to go straight down.
Is there a signal, a sell point, like some number? What
people should write to the site and get the research, because the answer is we're monitoring it, and we're very close to a top now. It's also been a top in 2000, 2007, 2013. Now it's much weaker than it was in 2000. We think it's going to turn
and very quickly, bonds. So many people for so long have been saying it's a bubble, but yet bonds have been very, very strong.
Let me give you the bond story in 30 seconds.
Great. That's all we have.
That's all you have. That's what there was a high 30 years ago in rates. 60 years ago, it was low. The U.S. government was actually selling, as opposed to buying, savings bonds 2.5%, 1950. 1920 rates were high. 1890 rates were low. 1860, the Civil War rates were high. So the next 30 years, you're going to see increasing rates. Starting this summer, there's going to be one more rally. We've been long bonds, more or less, since I've been working with Charles, because I know him about 10 years. He was a Goldman for 15. Same thing, cycle. So bonds are going to be a great short for the next 2 decades, starting this summer.
I don't know about that one, but very interesting stuff.
Definitely interesting stuff.
You have to check it out.
Yeah.
David Gurwitz, thank you very much.
Pleasure.
Sure thing. That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.